So say I've got a situation where Fannie Mae won't do my deal, probably because I'm at lower than normal occupancy, or I've got a C product that they don't like. Mm-hmm. Probably the biggest two reasons, you think?
Yes.
That Fannie Mae wouldn't do it? Okay. So those are the two reasons. Number one, it's lower than 85% occupancy, so Freddie Mac, Fannie Mae aren't going to do it. And there's certain C product that they don't like. If it's too old, they know there's a lot of deferred maintenance. There's things that are going to be constantly wrong with the property. And they don't like those types of deals. Same reason they don't like pitch roofs. So Fannie Mae, Freddie Mac, flat roofs, thank you. Freddie Mac, Fannie Mae are really good for B, C+, A properties. So then we go to the conduits. So what's conduits, what do they consider stabilized? How are they going to do it?
Well, right now, what the conduits are again, their underwriting is more conservative, so it is closer to Fannie Mae. That product that I was just talking about earlier, it's not necessarily something that I would go to immediately. There's another fallout plan. Typically, 2 years ago, you had national lenders that were not conduits, that were commercial banks, that would pick up the slack. Now, the market is a little more fragmented, and we've developed relationships with local banks in different regions. Let's say Texas, for instance, because that's just a territory unto itself. Local banks in different regions that have somewhat, they've compartmentalized their lending territories. So that's really what's picking up the slack for the Fannie fallout. Now, we've also got some soft bridge loans in place.
Explain what a bridge loan is and why somebody would use one.
Okay. A bridge loan is anything under, it's 24 months or less. 24 months or less is considered a short-term bridge loan. That's SBA standards.
Small Business Association.
Yes.
You notice, though, Eric talks and I interpret.
Appreciate that. He's the translator. Right?
Yeah.
But a bridge loan is used for stabilization for a property. Let's say that, like Dave was just talking about, a property is not stabilized. It's below 85% physical vacancy, physical occupancy. You want to get into the property to capitalize an opportunity, we're going to get you a bridge loan. That bridge loan is going to sit there for a year to 2 years. You're going to stabilize the property, and then we're going to roll that into the permanent loan. The permanent loan of choice right now, like Dave was saying, a blend of everything is Fannie Mae. The loan that they're putting out, in the majority, well, across the country, but they've got pockets where they restrict their guidelines, but primarily you're looking at on an acquisition, you're looking at an 80% loan to value. You're looking at a 30-year amortization and a 7 or a 10-year fixed period.
That's a balloon. So that means it's going to come due, which 7 to 10 years is pretty good. There's a lot of people that got stuck that were doing 3 to 5 year balloons over the last few years, and those are the notes that I was talking about earlier that are going to come due, and the owners may not be able to refinance because of where cap rates have gone.
Yes. Opportunities.
Yep.
Freddie Mac is another option. Very, very
What's
similar.
the big difference between Freddie Mac and Fannie Mae?
Freddie Mac and Fannie Mae, very similar in their loan structures. At the end of the day, when it's all said and done, your loans are not going to vary that much. And what they do, they've each got appetites, and they've got ways of looking at deals. One of the broad strokes is that Fannie Mae looks at regions. They look at Michigan, Ohio, Indiana, Florida, Louisiana, pockets of Texas. They paint broad strokes in regions, and they restrict their loan to values. They raise their debt service coverage ratio.